So this case study is called credit risk or someone's probability to default. This is a very common case study, and we will see how things work in a real world scenario. Okay. Or companies make profit out of it. Everyone can hear me, right? Okay. So the probability of default means all of us are applying for loans in banks, right? So everyone will not get loans. Why? Because some of us might have certain probability to default. And there is a threshold value. Like if the probability is more than this threshold, then the chances of that person to default increases. As a result, banks will not give you loan because banks do not want to take that risk. Okay. So if someone defaults, the risk of the banks increases, and as a result, bank will not take that risk. Why? First, it will make losses. Second, reputation is at stake. See, most of us, we know how Vijay Mallya has taken a huge loan and defaulted and have run out from the country. And post that, people have decided, especially our young generation has decided that we shouldn't be going ahead and opening accounts in SBI, right? So the reputation of SBI has gone at stake with one incident. So such kind of things are very, very critical for any bank. That's why they make sure that this probability of people defaulting stays as minimum as possible. Now, let us see what banks want to decide. As I mentioned, lending money to people. So here comes something we called propensity. That means the likelihood of someone defaulting. We can't say with assurance, right? We can say that only the likelihood of someone defaulting. Now, you might say, say, for example, when we talk about such kind of things, at that time, what comes in mind is how is it even possible? Because banks, one person is having multiple bank accounts. So how will bank know that if I will default in one bank or the other? Very valid point. So here comes something called credit bureau. Okay. So imagine I'm ICICI Bank. I
Hello.
Yeah. So imagine I'm Sibyl or I'm credit bureau. There are three, four credit bureaus as such: Sibyl, Experian, Epsilon, and CRIF. So these are the four credit bureaus who have data of each and every individuals of India and US largely. And they have created a report based on our historical behavioral pattern, how many loans we have taken before and how are we paying or repaying that loan, how many, I would say, how our income has increased over time, how many dependents do we have right now. So this is how lot of data points are there in that particular data set. And Sibyl's job is like to collect that data from various banks and create an internal report. I will not go into the nitty-gritties how Sibyl does that. Now you see, Sibyl knows that. So Sibyl has my information, and if I'm having multiple bank accounts, Sibyl has that information as well. Okay. Now, by RBI's guideline, which is Reserve Bank of India or Federal Bank in US, a bank cannot know the internal information of a customer of another bank. But there is Sibyl, right? So it's not bank's job to know that. Bank will just ask Sibyl, tell me the score. And the score is being forwarded from Sibyl to the bank's end. Now, what is the bank's job? Based on that score, bank will create an internal score. And in that internal score, what will there be? The bank, in the bank, if you have any debit related information. So CIBIL is mainly credit related information. How much credit or how much expenses or spend you are making. But along with that, you are also creating assets, right? You might have mutual funds, you might have FDs, such kind of assets. Those information CIBIL will never have. None of the credit bureaus. That's why the name is credit bureau. Those information is only with the bank. So bank will see, okay, this person has, say, in a month, 50,000 as his credit. expenses he has made. 20,000 as EMI. Now, how much asset is he holding? In the bank, he is saying, okay, he has 5 lakh rupees as deposit. So from that, if I give him, say, 3 lakh rupees loan, I can get it back from the 5 lakh rupees deposit that the customer is having. This is at a very high level. Okay. So this is a business problem which we decided. From there, we have identified the data sources. There will be credit bureau, which will have the credit level information. There will be asset level information of the bank in itself. There will be other historical information or the behavioral pattern that the bank will have specifically. Now, once you gather all the data sources, next part is doing exploratory data analysis. You analyze the data and you recognize like what is the trend, how over time, it is not like 1 year data. Generally, these kind of information, we see the trend across 3 to 4 years. What is the trend for last 3 to 4 years? How he has become better with time? How his income has increased, and with increase in income, did his expenses increase a lot? Then the risk is higher, right? Did his dependence increase a lot? That is also incurring more risk. So such kind of information we try to analyze. And finally, we go to feature engineering, where we see certain categorical features, like things are written in, say, categories, okay, in alphabetical order. Those things we try to convert them into numerical features. We try to gain information from those numerical features. We try to create delinquency flags. That means how many times he has made late payment towards EMIs. Because late payment, if you are making, that means you are at a higher risk for the bank. You might default. So such kind of flagging system we create. We create ratios, like how much limit you have in your credit card and how much have you used in your credit card. What is that ratio? How have you maintained that ratio over time? So that ratio will be good enough if your income is pretty well compared to your expenses. So these are extra features that we create from the current features that we obtain from various data sources. Once all these processes are done, then we use modeling, where in the modeling, generally we opt for logistic regression, which is a very, very simple model. And we validate that using these kind of particular performance metrics, which we call Gini, then K statistics, which is Kolmogorov-Smirnov statistic, AUC ROC curve. I'm not getting into the nitty-gritties once again, but just understand this modeling will give me result if it will be the target variable will be 1 or 0. 1 over here identifies that he will default. 0 means he won't default. And finally, you will put this modeling scores, the PD, the probability that you're going to get, into risk bands, which we call low, medium, height. And based on that, you set the limit, how much loan you can give or whether you can give loan or not. Also the interest. So if someone is a higher defaulter or at a higher risk, bank will not completely remove that, okay, I won't give him loans at all. Instead, bank will charge him higher rate of interest because bank is taking more risk by giving him loans. Okay. So bank needs you to default at times, and that is the reason, like slightly on that defaulter zone, so that bank can charge you higher interest rates. So we got an idea how credit risk works. And these are some at a very high level. What are the key concepts and what are certain different metrics that we use? But I'm not going to these nitty-gritties again. But one important thing is I wanted to touch base on this is called class imbalance. See, if you have 100 customers or 1,000 customers, the number of customers who might default is only 3 or 4. So it's very less. So there is a very huge imbalance in the class. Zeros will be zeros will be largely say 9,997 and 3 will be 1. So this count of 1, which is 3 only, those many people have defaulted out of 1,000 customers. So when you teach a model, the model will automatically have this thing like, okay, I will like I will be highly taught on the ones where there are zeros. Now, it might happen later on that whether certain customers are showing behavioral trait like zeros, so model is failing to understand whether he will default or not. Maybe that customer, there is a very thin line between 0 and 1. One particular place, if you change slightly, that can become 1. Model is not failing to identify that. So this class imbalance is a huge problem when we are working in credit risk or such kind of a model. So there are specific ways to make sure that the imbalance is not that high, and we try to integrate some more ones, artificially created synthetic kind of creation, you can say, so that bank can model can understand it. We give weightage, more weightage to the ones rather than the zeros, so that the model can realize, okay, ones are very sensitive over here. If certain independent features are, check, sorry, my bad. Certain independent features are changing by slight delta itself, very slight numbers, then itself it will get triggered and it will identify or make the prediction as one. So such kind of important uh, focus on the real-time original data set itself becomes very crucial when we are working with credit risk model, the imbalance in the credit risk in itself. But you might say, suppose if I'm talking about marketing analytics, there also it is very less. By that I mean, what are the chances that an advertisement is being shown to you by email or SMS and you are clicking on that? That click to open or click to see ratio is also equally less. It is also highly imbalanced. But both are different kinds of problem of two different domain. And that is why the both problems, the way we are going to solve that imbalance won't be same. For that marketing analytics example which I took, we can use neural network over there. It is black box, we don't know how it happened, but we cannot use a black box technique when I'm talking about credit risk over here, because I need interpretability. That means if tomorrow a customer comes down to the bank and tells the bank that why did you didn't give me a loan, why did you cancel my loan? There should be a valid explanation that uh, you are a risky customer. Why? Because over time we have observed that you are taking a lot of loans and we cannot give you more loans. Your EMI is, say, 80% of your income. So that goes against our rule of giving you loan. So these kind of interpretation is very essential when you are working in credit risk kind of a model, because it helps in auditing as well. And as a result, we have to choose a model via which we can interpret. So logistic regression, linear regression works best over here, because these are based on coefficients. And from the coefficients, you can understand, you can make that interpretation. However, if I talk about neural network, you cannot do that because it is built on something where it works, like it will work in some way at the first time, second go, it might change. So this is why uh, this is a bit different, but in the same zone in finance itself, if I am talking about marketing analytics, then it will work in a different way.